Do you want to know why I bought PayPal and Square for my portfolio? Which one do I expect a higher return from, and which stock do I consider safer? Hi guys, welcome back. This is the Smart Invest. In this video, we will analyze Block, better known as Square, and the PayPal company. We can say that both companies have seen better days, at least in terms of their stock prices. Both of our players have experienced a drop of more than 80% from their all-time highs. We've already realized that if someone invested their hard-earned money in either of these companies at this point, they're not feeling too cheerful. But what will the situation look like in a few years if I invest at this point? Of course, I won't invest all my money, and I won't ask for my grandma's retirement savings. And it's also important to emphasize that this video is not financial advice. So let's see how the numbers stack up behind these fallen companies. Let's start with Square. For those who may not be familiar with the company, let me briefly introduce it. Square is an American financial technology company that offers electronic payment solutions and other financial services to small businesses and individual users. Its founder and CEO is Jack Dorsey, who is also a co-founder of Twitter. It's important to understand that Square doesn't just offer payment solutions. It's building a full-fledged financial ecosystem for small businesses and individuals. The company focuses on technology development and innovation and is rapidly evolving in the financial technology sector. Square has become popular among small businesses as it simplifies payments and offers many useful services to enhance financial transactions and business operations. Currently, Square has a market capitalization of $25 billion, and we can see that analysts predict a doubling of its value in the next 12 months. With a forward PE ratio of 19, we can conclude that the company is expected to turn a profit next year. This can be favorable or unfavorable for us. If the company indeed manages to turn a profit, there's a good chance it will make a significant jump, and I think the stock could reach $80–100 share. However, if it fails to meet these expectations, it could deliver more blows to the stock price. Looking at Square's revenues, we can see a steep growth trajectory from 2020 onwards. Square is aggressively expanding and reinvesting almost all of its money into growth. We can see that they haven't shown significant operational income because they're reinvesting all the funds. The budget for research and development is growing exponentially, which I personally like with this kind of small market capitalization company. However, it's not so great that they're aggressively issuing new shares, which leads to a dilution of your shares. When a company issues new shares, it reduces the value of your shares, and the company inflates its own shares. From an investor's perspective, such significant share issuance can be very disturbing, and unless there's a compelling reason for the company, it can easily be a deal breaker. In the case of Square, the reason is the expected future growth, which, in my opinion, is not yet fully priced into the current stock price. The 33% gross margin isn't bad, and over time, it should hopefully increase. Another reason to like the company is the $17 billion in assets behind it. So it's trading at a very reasonable price-book ratio of 1.38. Square's working capital is also increasing nicely, which is a good sign. However, there's one issue. Why do they need to issue so many new shares, especially at such a bad valuation? Square has continuously issued new shares, causing a dilution of the value of existing shares, and sometimes the numbers are quite high. Considering their valuation, even these issues can be overlooked because they have a significant potential for long-term negative effects. Probably I'll take profits on Square after a significant increase unless they make drastic changes to their share issuance strategy. There are plenty of problems around Square, but let's take a look at the company's current valuation metrics. The price-sales ratio is at 127, which has never been seen before. The price-book ratio is at a record low of 141. These are the metrics that genuinely pique my interest in Square. I think that in the next 1–3 years, we can easily reach a doubling or tripling of the stock price. Now let's look at PayPal. But first, let me introduce today's video sponsor, who is none other than you. Yes, you heard it right, it's you. Being a small channel, even a simple like can make a huge difference, and if you're interested in the world of investments or would like to follow the performance of my S&P 500 killer portfolio, I recommend subscribing as well. Our other friend, PayPal, started experiencing quite significant declines, and it seems the stock price doesn't want to stop falling. First, let's briefly see what we know about PayPal. PayPal is a global financial technology company that offers online payment and money transfer services. PayPal is a secure and widely accepted payment solution in many countries around the world. The company actively develops its technology and services to make online payments and money transfers easier for customers. Both individuals and businesses use PayPal to simplify online financial transactions and facilitate international trade. PayPal has a market share of 47% in the payment management market. PayPal competes with 104 competitor tools in the payment management category. The top alternatives for PayPal's payment management tool are Stripe with 36.13%, Authorized Net with 5.11%, and Square Point of Sale with 3.74% market share. We can say that PayPal is the king of its category at the moment. So why did the stock price of PayPal drop? Analysts expected significantly more future growth 2 years ago than they do now, which could be one factor. The slowing growth of PayPal has raised concerns among investors. We can see that PayPal's growth is slowing down, which is why investors are starting to worry. Even though PayPal is experiencing growth, it's slowing down, and investors are concerned. We can see that it hasn't shown double-digit growth since 2022. Nevertheless, PayPal is currently the market leader, and I believe they will find a way to overcome these issues. So let's take a look at the numbers. The company is currently valued at just over $56 billion. You might notice that the PE ratio is relatively low at 14, and there's a forward PE ratio of 9. These indicators suggest that the company is not overpriced. We can also see that analysts expect a 60% increase in the next 12 months, which is not bad. PayPal's revenues are growing, even if at a slower rate. Operational income is also steadily increasing, and the last quarter saw over $1 billion. The next point is PayPal's stock count. In recent times, PayPal has aggressively started buying back its own shares. The stock price has plummeted, and with strong free cash flow, they've initiated stock buybacks. It's very good to see such action from a company. On a quarterly basis, they repurchased shares worth $1.5 billion. However, not everything is perfect with PayPal. This is why the stock price is around $50. Even with strong free cash flow, the last quarter turned negative due to significant expenses. Despite this, I'm not too worried because they generally generate over $1 billion in free cash flow, and the recent negative figure was mainly due to a one-time large expense. PayPal's gross margin is continuously decreasing, which could be a concerning issue. Long-term, such a situation isn't sustainable. This is actually the first thing that genuinely looks alarming. However, the profit margin doesn't decrease as dramatically, which suggests they have control over the situation. When looking at PayPal's valuation metrics, we can see that the PE ratio hasn't been this low in the past 10 years. The price-sales ratio is at a 10-year low. The price-book ratio also hasn't been this low since 2015. Taking all these aspects into account, I think I'll be able to make money with PayPal as well. In my opinion, it's easily possible to see a stock price of $100–$150 share in the next 2 years. That's it for today's episode. I'll bring a new video on Monday where we'll learn how to choose stocks for purchase. If you liked the video, found it informative, and would like to help me on my journey toward 1,000 subscribers, please press the like button and subscribe. Take care, guys, and see you on the next episode. Remember, try not to lose all your money on the stock market before the next episode.